If you have ever wondered why billionaire investor Warren Buffett is so popular on Wall Street, look no further than this track record as CEO of Berkshire Hathaway, BRK.A 0.14%, BRK.B 0.19%. Since becoming CEO in 1965, the Oracle of Omaha has nearly quadrupled the S&P 500's average annual total return, including dividends, 20.1% against 10.5%. This outperformance was maintained throughout the 2022 bear market. Despite the S&P 500's 19% loss last year, Berkshire Hathaway shares rose 4%. In other words, knowing what Warren Buffett is buying and selling is important since he has a habit of running circles around the large market. Welcome to our YouTube channel about Warren Buffett and value investing. What will happen? Before we continue our video, subscribe to our channel and hit the bell icon for more informative videos. Thankfully, 13F filings with the Securities and Exchange Commission and Berkshire Hathaway quarterly operational results provide a clear picture of what Buffett and his investment teams are interested in. Warren Buffett is betting big on the few stocks listed below as we approach 2023. Chevron. The amount of cash invested in energy firms by Warren Buffett and his colleagues last year was perhaps the most significant change in his investing strategy. The integrated oil and gas giant Chevron, CVX, 0.97%, topped the list. Buffett's business invested an estimated $20.9 billion on Chevron stock over a 2-year period commencing October 1, 2020 and concluding September 30, 2022. Prior to 2022, energy equities accounted for no more than 8.9% of Berkshire Hathaway investment portfolio. This allocation increased to 13% last year, indicating that Buffett and his colleagues expect energy commodities prices will continue high for the foreseeable future. Finally, supply and demand determine where the current price of crude oil will go. The worldwide supply of crude oil and natural gas is in jeopardy when Russia invades Ukraine, and global energy firms underinvested in drilling, development, and infrastructure during the COVID-19 pandemic. Given the impossibility of rapidly increasing supply of these energy commodities, supply and demand economies would suggest that moderately rising demand may result in stably higher crude oil and natural gas prices. Aside from rising energy commodity prices, Buffett must be happy with Chevron's significantly strengthened balance sheet and bolstered capital return programmer. Chevron's net debt decreased from $25.7 billion to $8.2 billion in the first 9 months of 2022. Furthermore, Chevron has raised its basic yearly dividends for the previous 35 years. Apple. Perhaps the least surprising stock on which Warren Buffett is banking heavily in the coming years is Apple, AAPL, 0.47%. I say least shocking since Apple is already Berkshire Hathaway's most valuable stock by a wide margin. However, this hasn't stopped the Oracle of Omaha from increasing its holdings. Although innovation has been a cornerstone of Apple's value for decades, it has really been the driving force since the iPhone was debuted in 2007. Since the introduction of 5G-capable iPhones 2 years ago, Apple has regularly accounted for almost half of all smartphone market share in the United States. But Apple is more than just the tangible things that have won it fame. It has been progressively growing its range of subscription services and maturing into a platform-based corporation for years. Subscription services provide long-term strong margins and double-digit sales growth. Most significantly, as services become a great portion of Apple's total revenue, income fluctuation associated with iPhone replacement cycles will be reduced. Apple's capital return plans are equally impressive. It has repurchased $554 billion in common stock since the beginning of 2013. To put this in context, just 5 S&P 500 businesses have a market cap more than $554 billion. Apple is one of them. Occidental Petroleum. Not only has Chevron piqued the interest of Warren Buffett and his colleagues in the oil sector, Berkshire Hathaway purchased more than 194 million shares of Occidental Petroleum (OXY), 0.14% last year. In addition to the $10 billion of Occidental preferred stock earning 8% per year that Buffett's business have owned since 2019. Occidental Petroleum drivers are comparable to Chevron's, but with a few differences. While both businesses can profit from sustained increase in crude oil and natural gas prices, Occidental revenue mix is much more skewed to drilling than Chevron's. This means that an increase in the price of West Texas Intermediate (WTI) crude oil per barrel might significantly boost Occidental's operating cash flow. On the other hand, Occidental's balance sheet is shambles when compared to Chevron's. Occidental has been buried in debt following its 2019 acquisition of Anadarko Petroleum, but Chevron has one of the lowest debt-to-equity ratios among oil and gas firms. Although the firm has effectively decreased its net long-term debt by $15 billion over the last 2 years, it will still require WTI oil prices to remain elevated in order to further lower its net long-term debt of $20.5 billion as of September 30, 2022. Despite these worries about leverage, Occidental Petroleum has revived its share buyback program and plans to continue reducing its long-term debt. The Bank of America. Buffett's second largest publicly listed position is Bank of America, which accounts for 10.4% of his portfolio. The company merits investor attention now for one simple reason. Although many industries fear higher interest rates, banks welcome them. Bank lends at greater interest rates than they borrow at, pocketing the difference. When interest rates rise, the difference between what a bank earns grows. More here. The 10 finest investment apps for once-in-a-life possibilities even if you are a newbie, and as it happens, Bank of America has been increasing its dividend payments to stakeholders. Bank of America increased its quarterly dividends by 5% to 22 cents per share in July, following a 17% rise in July 2021. At the present share price, the bank provides a 2.7% annual dividends. Taiwan Semiconductor Manufacturing Company. The Oracle of Omaha and his staff are likewise bullish on Taiwan Semiconductor Manufacturing Company, TSM, 2.27%, popularly known as TSMC. Berkshire Hathaway acquired around $4 billion in TSMC shares in the third quarter of 2022. While there are probably other reasons for this acquisition, the most plausible is that TSMC is Apple's sole source of silicon CPUs. TSMC manufactures every Apple device that uses silicon CPUs. With Apple accounting for more than 37% of Berkshire's invested assets, it makes sense to gamble on the success of one of Apple's key suppliers. Another reason Buffett and his investment team are optimistic about TSMC's prospect is its scale. It is the world's largest foundry and appears to have its metaphorical finger in every business that uses semiconductor solutions. Although smartphones and high-powered computers account for 80% of its fabrication income, the business is now making 10% of its revenue from Internet of Things (IoT) devices and 5% from next-generation autos. IoT and automobiles are both experiencing double-digit growth. Taiwan Semiconductor also offers a market-leading 2.4% yield. Buffett has long admired publicly listed firms that reward their shareholders for their patience. Berkshire Hathaway. The sixth stock on which Warren Buffett is relying heavily in 2023 is none other than his own Berkshire Hathaway. He and Executive Vice Chairman Charlie Munger have authorized the repurchase of more than $63 billion in Berkshire Hathaway common shares since mid-July 2018. That is more than Berkshire have spent on Apple and Chevron stock since the beginning of 2016. One of the reasons Buffett supports share buybacks is because they allow investors to grow their ownership position without having to do anything. If the number of outstanding shares is reduced, each remaining share owned by investors becoming increasingly rare and potentially valuable. Another motivation to complete share repurchases is to make a firm more appealing to investors on a fundamental level. A corporation such as Berkshire Hathaway that has consistent or rising net income excluding unrealized gains and losses. With his investments and a shrinking outstanding share count, the company's earnings per share should rise over time. But the Oracle of Omaha's aggressive share purchase is also a clear indication that he expects his investment and acquisition strategy to continue paying off, as it has for the past 58 years and counting. Berkshire Hathaway portfolio is heavily on cycling businesses and over a dozen dividend-paying firms. In summary, it is well positioned to gain from prolonged bull markets. Amazon. Buffett is unquestionably a great investor. He has, however, dubbed himself an idiot for not buying Amazon shares sooner. Berkshire's younger investment manager helped to fix the miscalculation, and the company will establish a position in the e-commerce and cloud hosting juggernaut in 2019. Berkshire Hathaway's investment in Amazon has grown considerably over time. Despite this expansion, the stock remains only 0.3% of the conglomerate's entire portfolio. That was advantageous in 2022, when Amazon stock plunged by around 50%. Next year, we can expect a major return. The consensus price target for the stock is more than 60% higher than the current share price. In December, Refinitiv polled 47 analysts, and 43 of them rated Amazon as a buy or a strong buy. Coca-Cola Company Inc. If the Fed raises its key interest rates to 5% to 5.25% target range projected by the central bank in December, consumer staples such as Coca-Cola should perform relatively well and be less sensitive to interest rate hikes than Berkshire Hathaway's industrial and financial stocks, according to Cass. He further points out because Coke is a consumer staple stock, it should only see a little drop in sales if a recession occurs. Because Coca-Cola is so widely available, people buy it regardless of their financial status. Solomon argues, as a result, it may raise prices as needed without fear of losing clients. The Procter & Gamble Co. This consumer goods behemoth is also seen as a safer pick during economic downturns, offering everything from diapers to detergent. After all, regardless of the state of the economy, people will buy shampoo and toothpaste. The company's lower risk profile may also appeal to retirees and those with the lower risk tolerance. It has a low debt to operating profit ratio, making it well adapted to deal with tough economic circumstances, and it has continuous revenue growth. According to Decina, strong financial posture, a stable growth profile, and consistent income distribution suggest that Procter & Gamble is a strong selection for ordinary investors with a reduced risk appetite, he writes. So this was all about the video. For more videos, make sure to subscribe to our channel and hit the bell icon for more videos. Thanks for watching and have a great day.